The UK property market is changing forever. Mortgage rules are loosening, listings are surging, landlords are exiting, corporates are still buying, and new tax ideas are circling. Whether you own, rent, or you're trying to buy, the next 6 to 12 months will look nothing like the last 6 to 12 months. Today, I'm breaking down the 5 shifts most people are completely missing. The single data point that I think unlocks the 2025 to 2026 market, and what to do right now. No matter if you're a homeowner, first-time buyer, or landlord. Quick context on why you should bother listening to me. I founded British Home Buyers and British Home Sellers back in 2013. My teams have managed thousands of transactions, totaling over £5 billion in property sales. I'm in the data every day. I'm in the deals every day. And my goal isn't to scare you. It's to show you what the numbers are actually saying. So here's what you're getting from this video. What actually changed in mortgages and why it matters more than a single headline rate cut. Why supply is up, but that does not automatically mean cheap houses for all. The real landlord exit versus corporate consolidation story. The tax idea shaping behaviour right now, even before anything becomes law. And finally, a clear playbook for owners, buyers, landlords and renters for the next 6 to 12 months. If at any point you find this helpful, tap like so more UK viewers who need this information actually see it. Let's start with the mortgage rules that were quietly loosened. For years, lenders stress-tested affordability at extreme reversion rates plus big buffers, even when the real-world 2 to 5 year fixes were far lower. Thousands of people who could afford the actual payments were denied on the technical test. That's changing. Regulators have signaled lenders can use more realistic forward views instead of permanent worst-case scenarios. High loan-to-income limits now only apply to larger lenders, giving smaller ones room to offer 4.5 to 5.5 times income in the right case. Remortgage switching is simpler. Overpayments and term changes are easier. Bottom line, credit is loosening. Not a free-for-all, but enough to pull marginal buyers back into the market. And in the constrained supply environment, easier credit almost never lowers prices. It usually props them up. Listings have hit their highest level in years, but demand hasn't risen at the same pace. Many people who locked in 1-2% mortgages in 2020 and 2021 are now facing payment realities that are 2, 3, sometimes 4 times higher. Even with better testing rules, some can't refinance easily, AMs choose or are forced to sell. Add budget noise on top every time a major announcement is coming, people delay decisions for 2 or 3 months. That delay stacks demand, then releases it all at once. The result, right now, is longer time on market, more negotiating power for buyers who can pass affordability, and far more price reductions. In fact, price reductions have hit a record high, this year 17.8% up compared to last year. But more reductions don't automatically equal a crash when credit is easing at the same time. What you get instead is churn. More sales agreed, more fall-throughs, more repricing. Then there's the landlord exit versus corporate consolidation. Small landlords have been squeezed for years. Section 24, higher stamp duty surcharges, EPC uncertainty, and now the Renters' Rights Act rollout. Margins are thinner, headspace is smaller, and the median landlord is 59 years old. Many are taking the win and de-risking. Who fills the gap? Ill-to-rent institutional players taking whole blocks and large portfolio landlords who can absorb compliance costs at scale. For tenants, this matters because smaller landlords are statistically more likely to hold rent for good tenants. Large operators run on policy and algorithm, not evil, just big. For investors, the message is clear. Yield resilience and operational excellence matter more than ever. When regulation increases, scale wins. We've seen this on every high street in the country. Now, let's talk taxes. No changes have actually happened yet, but the ideas alone are reshaping behaviour. Seller stamp duty flips. Annual land value levies. £500,000 value thresholds being floated. National insurance on rental income for individuals, not companies. Capital gains tweaks. The point isn't certainty, it's anticipation. People pause decisions. That pause creates pent-up demand and a short-term bulge in listings. Then, after announcements, almost everyone makes the same decision they were planning to make anyway just later. That's why I expect a December reboot and a January-February surge in viewings, offers and agreed sale. Regional outcomes will vary. The North and Midlands remain more affordable. London and the South East are dramatically more price sensitive. One more thing. National house prices look flat to slightly up in nominal terms, but once you adjust for inflation, the market has actually delivered a real terms fall. That's why things feel tougher even though the headlines show 2 to 3% increases. For buyers, the pain isn't the sticker price its rates plus living costs. For owners, don't get intoxicated by nominal gains. Look at real equity. For landlords, the real return is net yield. Capital growth is a bonus, not the foundation. So, what do you do with all that? If you're a homeowner, price for the market you're actually in. The first 14 to 30 days are crucial. Get conveyancing prepped up front and shave weeks off your transaction. If you're upsizing, a 2 to 3% market move matters far more on the buy side than what you squeeze out of your sale. If you're a first-time buyer, plan affordability based on the maximum monthly payment you can live with today, not on future fantasy rates. Check multiple brokers because smaller lenders now have more room to help. If you're a landlord staying in the game, re-underwrite your portfolio today. Lock in the weak links first. Systemize inspections, arrears, compliance. Hunt micro-markets where yields still hit 7 to 8% after realistic costs. If you're exiting, decide now if you want to hit the Q1 demand bump. If you're a renter, ask for a 12 to 24 month fixed contract for stability. And if you can buy, don't panic. Being chain-free is powerful leverage right now. The UK property market has changed, but not in a way that requires panic. Credit is loosening. Supply is up for stressful reasons. Small landlords are thinning out while big operators scale up. Tax talk is creating a timing wobble that will likely release in Q1. If you stay clear on your numbers, your time horizon, and your strategy, you can still make excellent decisions in this market. If this helped, hit subscribe and share this with someone who's stuck in decision limbo. I'll see you in the next video.